everyone, welcome back to my channel. Today we'll be discussing tax consequences of hobby versus business versus income producing activity. And if you haven't already, please subscribe and hit that like button. If the IRS declares your business activity is really a hobby, then they can eliminate all of your tax deductions for the activity. That's why it's so important for you to be able to show the IRS that your activity is a real business. So then how do you prove that you are in business? For tax purposes, a business is an activity that you regularly and continuously engage in to earn a profit. Your business can be conducted from anywhere, full-time or part-time, as long as you work at it regularly and continuously. And you don't even have to show a profit every year to qualify as a business. As long as your primary purpose is to make money, you should qualify as a business. In order to determine whether someone has a profit motive, the IRS has established two tests: profit test and behavior test. Profit test. If your venture earns a profit in 3 of 5 consecutive years, the IRS will presume that you have a profit motive. The presumption that you're in business applies to your third profitable year and extends to all later years within the 5-year period, beginning with your first profitable year. So let's say you begin to work as a self-employed graphic designer in 2016. In 2016, you had a $10,000 loss, but in 2017, 2019, and 2020, you showed a profit. If the IRS audits your taxes for 2020, it must presume that you were in business during that year because you earned a profit during 3 of the 5 consecutive years ending with 2020. The presumption that you're in business extends through 2022, 5 years after your first profitable year, which was in 2017. The IRS and courts look at your tax returns for each year you claim to be in business to see whether you turned a profit. Any legitimate profit, no matter how small, qualifies. You don't have to earn a particular amount or percentage. This is why year-end planning with your CPA is so important. Careful year-end planning can help your business show a profit for the year. Behavior test. The sad fact is that many businesses don't earn profits every year or even for many years in a row, especially when they're first starting out. Indeed, over 4 million sole proprietors file Schedule C tax forms each year showing a loss from their businesses, yet the IRS does not categorize all of these ventures as hobbies. You can continue to treat your activity as a business and fully deduct your losses even if you have yet to earn a profit. However, you must take steps to demonstrate that your business isn't a hobby in case you ever face an audit. You must be able to convince the IRS that earning a profit is your primary motive for doing what you do. This will require some time and effort on your part. People who have incurred losses for 7, 8, or 9 years in a row have been able to convince the IRS that they were running businesses. The IRS looks at few factors to determine whether you are behaving like a person who wants to earn a profit. You don't have to satisfy all of these factors to pass the test. The first 3 factors are the most important by far. The IRS factors are: 1. Whether you act like a business. This means you keep good books and records and carry on your activities in a professional manner. 2. Your expertise. People who are trying to make money usually have some knowledge and skill in the fields of their endeavors. 3. The time and effort you spend. People who want to make profits work regularly and continuously. You don't have to work full-time, but you must work regularly and continuously rather than sporadically. Although there is no minimum amount of time you must work, you will have a hard time convincing the IRS that you want to make money if you work fewer than 5 or 10 hours a week. Keep a log showing how much time you spent working. You can just mark down your hours and a summary of your activities each day on your calendar. 4. your history of profit and losses. Even if you can't satisfy the profit test, earning a profit in at least some years helps show that you have a profit motive. 5. Your personal wealth. The IRS figures that you probably have a profit motive if you don't have substantial income from other sources. After all, you'll need to earn money from your venture to survive. On the other hand, the IRS may be suspicious if you have substantial income from other sources, particularly if the losses from your venture generate substantial tax deductions. 6. The nature of your activity. If your venture is inherently fun or recreational, such as art, photography, writing, training, and showing horses, the IRS may doubt that you are in it for the money. Even if they don't qualify as businesses, they can still be classified as income-producing activities, which is better than being a hobby. Here are 6 ways to pass the behavior test. This will not only help you with the IRS, but will also help you actually earn a profit someday, or at least help you figure out that your business will not be profitable. 1. Keep good business records. Keeping good records of your expenses and income from your activity is the single most important thing you can do to show that you want to earn a profit. Without good records, you'll never have an accurate idea of where you stand financially. Lack of records show that you don't really care whether you make money or not, and it is almost always fatal in an IRS audit. In Flanagan versus Commissioner, Tax Court Memorandum 1999-116, a computer consultant who sold software on the side at a loss was found not to be profit motivated because he didn't keep adequate records. The tax court found that his failure to keep records meant that he was unaware of the amount of revenue he could expect and had no concept of what his ultimate cost might be or how he might achieve any degree of cost efficiency. 2. Keep a separate checking account. Open up a separate checking account for your business. This will help you keep your personal and business expenses separate, another factor that shows you want to make money. 3. Create a business plan. Draw up a business plan with a realistic profit and loss forecast, a projection of how much money your business will bring in, your expenses, and how much profit you expect to make. The forecast should cover the next 5 or 10 years. 4. Get business cards and letterhead. Hobbyists ordinarily don't have such things. You can use software programs to create your own inexpensive stationery and cards. 5. Create a website. Most businesses have some sort of website that, at a minimum, provides contact information. 6. Obtain all necessary business license and permits. Getting the required license and permits for your activities will show that you are acting like a business. Tax consequences of engaging in a hobby. A hobby is something you do primarily for a purpose other than to make a profit. You don't want what you consider business activities to be deemed as a hobby by the IRS. Because hobbies are not businesses, hobbyists cannot take the tax deductions to which business people are entitled. For decades, hobbyists were allowed to deduct their hobby-related expenses up to the amount of income the hobby earned during the year. Hobby expenses were deductible as a personal miscellaneous itemized deduction on IRS Schedule A. This meant they could be deducted only by taxpayers who itemized their personal deduction and only if they exceeded 2% of the hobbyist's adjusted gross income. This was not a very generous deduction, but it was better than nothing. Unfortunately, for people who earn income from hobbies, the TICJA, Tax Cuts and Jobs Act, completely eliminated the itemized deduction for hobby expenses, along with all other miscellaneous itemized deductions. The prohibition on deducting these expenses is in effect for 2018 through 2025. This means that taxpayers may not deduct any expenses they earn from hobbies during these years, but they still have to report and pay tax on any income they earn from their hobby. This tax change could be particularly devastating for the millions of Americans who work as self-employed salespeople with multi-level marketing companies like Amway, Mary Kay, and Herbalife. Most of the time they lose money, and the IRS and tax court have routinely found such activities to be hobbies for tax purposes. Fortunately, there is a tax loophole that allows them to deduct some of their expenses. IRS Regulation 1.183-1E permit people whose hobby involves selling items to deduct the cost of goods sold from their gross receipts, but not other expenses. Tax consequences of income-producing activities. You can't earn money without being in business. Many people do this all the time by engaging in personal investing. For example, investing in stocks that pay dividends and appreciate in value over time. Activities that are pursued primarily for profit but aren't businesses are called income-producing activities. They are neither businesses nor hobbies, and they receive their own special income tax treatment. The distinction is crucial because income-producing activities receive much less favorable tax treatment than businesses. Thus, you'll want to avoid this classification if possible. If in the course of an income-producing activity, you incur expenses to produce rents or royalties, you can deduct these expenses directly from your gross income, just like business expenses. What are rents and royalties? Rent is what you earn from renting real estate. Thus, landlords who don't qualify as business people may still fully deduct their expenses. Royalties are income from things like copyrights, patents, or mineral leases. If your income comes from real estate or royalties, you're listed and your expenses on Schedule E, Supplemental Income and Loss. Expenses incurred from any other income-producing activity, for example, investing, are miscellaneous itemized deductions. In the past, they were deductible as a personal itemized deduction on Schedule A to the extent they exceeded 2% of adjusted gross income. However, as a result of the TICJA, such expenses are not deductible at all for 2018 through 2025. Thus, for example, an investor in the stock market may not deduct fees for investment advice, accounting services, or the costs of subscriptions to investor newsletters. But such an investor must report and pay income tax on the investment income earned. There is one exception. Interest paid on money borrowed to make an investment is deductible up to the amount of income you earn from the investment. Also, fees and commissions paid directly from funds in an IRA or a pooled investment such as a mutual fund are subtracted from the income from the IRA. The investor only pays tax on the net income from the fund after such expenses are subtracted. Medicare tax on investment income. A 3.8% Medicare contribution tax must be paid on investment income by taxpayers whose adjusted gross income exceeds certain threshold amounts. $200,000 for single people and $250,000 for married couples filing jointly. If your AGI is below these amounts, then you don't need to worry about this tax. This tax does not apply to income from an active trade or business. However, people in business must pay a 3.8% Medicare tax on their net self-employment income over similar $200,000 or $250,000 thresholds. Moreover, they must pay a 2.9% Medicare tax on their self-employment income below the threshold, plus Social Security taxes. If you do earn more than the threshold amount from all of your activities combined, then you will be subject to the tax only if your business is deemed to be a passive activity. A passive activity is one in which you and your spouse, if any, don't materially participate in the business. There are several tests for material participation. You materially participate in a business if, during the year, you and your spouse, if any, are the only people who work in the business, spend over 500 hours per year working in the business, or spend over 100 hours working in the business and no one else, including employees, puts in more than 100 hours. Trading in stocks as a business. Professional securities dealers and traders in securities are in business because they are not investors. Such people are not subject to the restrictions on deductions as income-producing activities. Example, a professional stock trader may take a home office deduction. Professional dealers and traders may not deduct the commissions they pay to buy stocks or other securities. These are added to the basis or value of the securities for purposes of calculating gain or loss when they are sold. Traders who are sole proprietors list their expenses on Schedule C, profits or loss from business. However, they list their income or loss from trading on Schedule D, capital gains and losses. Buying and selling anything can be a business. It doesn't have to involve stock or other securities. If you earn your money from the activity of buying and selling, and you engage in it regularly and continuously, you can qualify as a business. For example, thousands of people now have businesses buying and selling items on eBay. However, sporadic buying and selling is not a business, even though it is profitable. For example, occasionally selling items on eBay won't qualify as a business.